FMCG major Nestle has reported its quarterly results above expectations in Q1 CY20 or calendar year 20 with a double-digit sales growth. With this, the company has delivered 7 quarters of uninterrupted double-digit domestic sales growth per se. In our ideas for profit today, I will discuss what has really helped the company sail through the COVID-19 led disruptions, as well as does it make it a good bet for investors right now and post its earnings. Well, first up, let's look at the positives in the Q1 earnings. Now, domestic sales grew by 11% year-on-year and 6% sequentially. That was aided by strong performance for key products such as Maggi, KitKat and Nestle Munch. Now, export revenues also grew by 13% year-on-year and 7% on a quarter-on-quarter basis. Export revenue, which has really seen degrowth for the last 4 quarters, has witnessed a turnaround in Q1 CY20. Sales from e-commerce segment grew significantly while COVID-19 related shutdown impacted the out-of-home food segment performance this time. Profit after tax of 525 crore rupees grew by 14% year-on-year. Nestle also adopted to a new tax regime announced back in September 2019, and the effective tax rate for Q1 CY20 stood at 25% as compared to 34% in the same quarter last year. So what are the concerns really? Well, the gross margins dipped just a notch to clock in about 56% this time. Compression in the gross margin was due to the higher commodity prices, particularly milk and its derivatives. Now, along with this, higher employee cost impacted EBITDA margins this time around. Employee cost increased by 19% on a year-on-year basis. EBITDA margin for Q1 CY20 stood at 24%. Now, other income was lower by 42% year-on-year due to the lower yields and lower average liquidities and payment of the one-time special dividend. Now, also, finance cost increased by 21% on a year-on-year basis. Nestle has stood by 1 lakh dairy farmers and paid them their dues this time around. Nestle has also paid all the dues of MSMEs, their dues on their time. Now, the company also worked with, say, coffee farmers, spice growers in Karnataka by sourcing a substantial quantity of tomatoes from their supplies as well to ensure there is no distress at this time. Now, overall implication of COVID-19 and the led lockdowns for the FMCG industry is still evolving, but would definitely have a clear impact on the supply chain management, working capital financing, and also the product category preferences in the post-COVID world. Now, in the coming days, FMCG companies with strong brand recall, presence in food and beverage sectors, as well as hygiene categories and nimble supply chain management like Nestle would definitely see market share gains. Now, we do expect Nestle's strategy of focusing more on trade channels such as e-commerce to yield results in the targeted consumers and optimizing costs. Now, in case of the near-term estimates, we do have assumed that sales growth of 10% for CY20 and 12% for CY21. Now, gross margin is likely to remain quite under pressure. As far as valuations are really concerned, Nestle is currently trading at rich multiple of 68 times CY21 estimated earnings. And having said that, Nestle is expected to witness relatively stable demand due to the high exposure it has to the urban areas. Hence, investors can consider this stock for accumulation on declines.